Have you ever watched your bank account drop by half in a single day? I have. And I can tell you, it feels like someone just punched you in the gut, took your wallet, and laughed in your face while doing it. My name is Andrew Meet Rich, and I used to be that guy, the one who chased quick money, who believed every hype train that rolled through town, who put everything on red and hoped for the best. I was broke, stressed out, and honestly, too ashamed to even check my balance most mornings. I made every money mistake you can imagine, and some you probably can't. Credit cards maxed out, payday loans stacked on top of each other, and yeah, I threw money at risky investments I didn't understand because someone on the internet said it was a sure thing. But here's what I learned the hard way. There are no sure things. There's only what you know, what you prepare for, and how you protect yourself when the world goes sideways. Today, I want to walk you through one of the most devastating financial events in crypto history, October 10th, 2025. On that single day, $19 billion in positions got wiped out, not millions, billions. And over 1.5 million people lost money, real people with real savings, not just some abstract statistic. Whether you're into crypto or not, the lessons from this bloodbath apply to every corner of your financial life. And hey, even if today's topic doesn't feel super relevant to you right now, trust me, the next one could change your life. So hit that like button, subscribe, and let's dig in. Let me take you back a few years. I'm sitting at my kitchen table at 2 in the morning, laptop open, eyes bloodshot, watching Bitcoin climb higher and higher. My buddy Marcus had just texted me a screenshot of his portfolio, up 40% in a week. 40%. And I'm thinking, man, I'm over here clipping coupons and eating ramen while this guy's buying his wife a new car. So I did what desperate people do. I borrowed money I didn't have and threw it into the market at the absolute worst time, right at the peak. I told myself it was different this time, that I had a system, that I'd just get in and get out quick. But here's the thing about greed. It whispers real sweet in your ear. It says, just a little more, just one more day, you're so close. And before you know it, the market turns, and that whisper becomes a scream. I lost half of what I put in within 48 hours. I couldn't sleep, couldn't eat, couldn't look my wife in the eye. I felt like the biggest failure on the planet. But that moment, that gut-wrenching, soul-crushing loss, it taught me something I'll never forget. Money isn't about luck or timing or being the smartest guy in the room. It's about discipline, patience, and never, ever betting more than you can afford to lose. And here's where most people get stuck. They think one big win will fix everything. It won't. Let me show you why. So let's talk about what actually went down on October 10th, 2025. $19 billion in liquidations in one day. To put that in perspective, the COVID crash back in 2020, the one everyone remembers, that was 1.2 billion in liquidations. The FTX collapse, which sent shockwaves through the entire industry, that was 1.6 billion. This was almost 20 times bigger than both of those combined. This wasn't just a dip. This was a financial massacre. Bitcoin had just hit a new all-time high, $126,500. Everyone was in full euphoria mode. Traders were sitting on maximum leverage, talking about fast profits, planning their exit strategies, which, let's be honest, most of them didn't actually have. The total market cap lost $670 billion in a single day. Ethereum dropped 18%. Some smaller altcoins, they got obliterated, down 90% or more. And here's the thing that really gets me. 1.6 million trading accounts got liquidated worldwide. That's not just numbers on a screen. That's real human beings who woke up that morning with savings and went to bed with nothing. Now, I know what you're thinking, Andrew. How does something like this even happen? Well, here's the brutal truth. Leverage. Traders were borrowing money to multiply their positions by 10, 20, sometimes 50 times. When the market moves in your favor, it feels like magic. But when it goes the other way, you get wiped out in seconds. And here's the kicker. There are no safety nets in crypto. Let me break down how this liquidation cascade actually works, because this is where people get destroyed. Imagine you have $1,000, but you want to control $10,000 worth of Bitcoin, so you borrow $9,000 from the exchange. Now you're leveraged 10 times. If Bitcoin goes up 10%, you just made $1,000. You doubled your money. Feels incredible, right? But if Bitcoin drops just 10%, you're done. Your entire position gets automatically closed, liquidated, and you lose everything. But here's where it gets even uglier. When thousands of leveraged positions get liquidated at once, it creates this snowball effect. Each liquidation forces a sell, which pushes the price lower, which triggers more liquidations, which pushes the price even lower. It's a death spiral, and it doesn't stop until every last leveraged position burns to the ground. That's exactly what happened on October 10th. In traditional markets, there are circuit breakers. Brokers call you, give you time to add more margin. Sometimes they even pause trading to let things cool down. Crypto? Nothing. It runs 24 hours a day, 7 days a week, fully automated. A 2% drop can wipe out an account with 50 times leverage in seconds. And on that day, $6.2 billion of those liquidations were long positions, meaning people were betting on the price going up. It looked safe. Bitcoin was at an all-time high. Where could it possibly go from there? Turns out down, way down, and fast. Here's the rehook, and it gets worse, way worse. So what actually triggered this apocalypse? Officially, it started with Donald Trump announcing a 100% tariff on China, plus export restrictions on critical software. China had just restricted exports of rare earth metals, basically trying to maintain their monopoly on materials the world needs for tech. Trump fired back hard. Markets freaked out. Bitcoin dropped from 126,000 to 105,000 in hours. 17% gone, just like that. But here's where it gets really interesting, and by interesting I mean shady as hell. About 20 to 30 minutes before Trump's announcement, some whale on a decentralized exchange called Hyperliquid opened short positions worth $1.1 billion. Shorts, meaning they were betting the market would crash. And guess what? It did. That trader made an absolute fortune. Coincidence? Yeah, I don't think so either. And here's the kicker. This same trader opened massive long positions right before the announcement of the US Strategic Crypto Reserve back in March. Made millions then too, twice. Perfect timing. On major political news. You can call it genius intuition if you want, but I'm giving it a 99.9% chance this was insider trading, plain and simple. The problem is, proving insider trading in crypto is nearly impossible. The market's decentralized, anonymity is guaranteed, and there's no SEC breathing down anyone's neck. Blockchain analytics show that big players were pulling money off exchanges a week before the crash. They knew volatility was coming. Meanwhile, regular traders were sitting on maximum leverage, dreaming about Lamborghinis. And the exchanges? Total chaos. When the panic hit, the infrastructure collapsed. Coinbase froze under the load. Robinhood lagged out. Kraken went down completely. People were trying desperately to close their positions, to salvage whatever they could, but they couldn't even log into the app. Imagine that horror. You're watching your money evaporate in real time, and you can't do a single thing to stop it. You're locked out. Helpless. That's not just a technical glitch, that's a nightmare. And then there were the flash crashes. On Binance, a coin called Atom, which has a market cap of about $2 billion, dropped to 1/10 of a cent. Not 1 cent, 1/10 of a cent. Then it bounced back to $3 within minutes. That doesn't happen on a normal functioning market. That's pure manipulation. Someone deliberately drained liquidity from the exchange, dumped massive sell orders, triggered cascading liquidations, and pocketed the money from everyone sitting on leverage. It's like watching someone rob a bank in broad daylight, except the bank is invisible and the cops don't exist. And here's the thing, that official $19 billion figure, it's probably way too low. Binance, the biggest exchange in the world, only releases one liquidation report per second because of technical limits. The real number is almost certainly much higher, but we'll never know exactly how much. That's the Wild West for you. No rules, no accountability, no protection, just you, your money, and a whole lot of sharks circling in the water. But then something unexpected happened. After the bloodbath, the market started recovering. Fast. Bitcoin bounced back to 112,000. Ethereum climbed to $3,800. That's 50 to 60% above the lows from that Friday. The Fear and Greed Index hit 64 points, technically back in greed territory. Buyers were returning, seeing the crash as a buying opportunity. But here's the question everyone's asking. Is this just a correction in a bull market, or is this the beginning of the end? Most analysts think it's a correction. The fundamentals haven't changed. Bitcoin is still a scarce asset with limited supply. Institutions are still entering the market. technical support levels held. And this is a big but, the trade war between the US and China is just getting started. Tariffs officially take effect November 1st. China will retaliate. The strong dollar keeps pressuring risky assets. Inflation might be higher than expected. Interest rates could stay elevated longer than investors hope. Translation: volatility isn't going anywhere. Buckle up. Now here's what you absolutely need to take away from all of this. 1.6 million people lost money in a single night. Real people. Real savings. Some were gambling with maximum leverage, no stop losses, and they lost everything down to the last penny. Others were holding spot positions without leverage. They experienced a painful dip, but still have their capital intact. What do serious financial advisors actually recommend? Morgan Stanley says, keep a maximum of 2 to 4% of your portfolio in crypto, depending on your risk tolerance. Most traditional advisors say no more than 5%. The most popular advice? Limit it to 2%. That's it. There are a few voices out there, like financial advisor Rick Edelman, suggesting more aggressive allocations, 10 to 40%, but that's the exception, not the rule. And even those aggressive voices never tell you to put everything into crypto, not even close. And within that small slice of your portfolio that is crypto, you're supposed to divide it up. More in conservative options like Bitcoin, less in riskier altcoins. Nobody with any sense is telling you to dump your entire life savings into some obscure coin you heard about on Twitter. The people who followed conservative advice from professionals, they lost at most 2 to 4% of their total portfolio, not everything. They can sleep at night. They're still in the long-term game. The rest of their portfolio is in normal assets, stocks, bonds, maybe real estate. Diversification saves lives in moments like this. When one sector crashes, the others hold you up. Leverage is a tool that multiplies both gains and losses equally. On a bull market, everyone looks like a genius, even people who have no idea what they're doing. But in a bear market, only the people who actually know how to manage risk survive. Betting everything and hoping for the best is a fast track to nowhere. This isn't a sprint. It's a marathon that lasts years, where the main goal is to survive and stay in the game. After events like this, regulation will probably tighten. Politicians and regulators saw tens of billions evaporate in a day. They'll want more control. They might limit maximum leverage. They might impose stricter requirements on exchanges to protect clients. Mandatory checks to ensure people can actually handle the risks they're taking. And you know what? That's not necessarily bad. One way or another, the market will regulate itself and the situation will improve, slowly but surely. Maybe there will even be trading pauses like traditional markets have. We don't know. But this experience will force transformation across the crypto industry and exchanges. More regulation could bring more trust from the general public and institutional money. Of course, regulation always swings too far at first, then pulls back. That's just the nature of things. The key is to quickly figure out where regulation is needed and where it's overkill. Now, there are some positive takeaways from this disaster. The technology held up under extreme pressure, blockchain networks stayed stable, transactions went through without issues, DeFi protocols withstood the onslaught, total value locked stayed around $166 billion. The core infrastructure proved to be solid. Bitcoin once again demonstrated its status as the relatively safer asset among cryptocurrencies. It fell the least and recovered the fastest. Institutional money flows into Bitcoin, not altcoins. Stablecoins like USDT and USDC maintained their peg to the dollar. People who moved into stablecoins early saved their capital from destruction. But the psychological trauma, that lasts a long time. More than 1.5 million people are now going to tell their friends and family that crypto is a dangerous casino where you can lose everything in seconds. The reputational damage to the entire industry is massive. On the other hand, the market brutally cleaned out weak hands. People who couldn't handle the pressure exited and won't come back. The ones who stayed? They have a much stronger psychological foundation and a way better understanding of the real risks. Liquidity got completely flushed out. If there aren't any new major shocks coming, we could very well see a real recovery start soon, built on stronger, more solid ground. The bottom line from all of this is pretty straightforward. The crypto industry just went through the biggest stress test in its entire existence. Liquidations 20 times larger than the COVID panic. People who played honest on the spot market without leverage, they still have their capital. People who speculated with maximum leverage and bet everything on one card, they lost it all. People who had access to insider information, or let's be real, criminal foreknowledge, they walked away with hundreds of millions in a single day. October 10th, 2025, will go down in history as the day the crypto industry showed two things at once. First, its strength and ability to recover quickly after catastrophic events. Second, its weakness to manipulation and the complete lack of protection for regular participants. Look, I'm not here to tell you what to do with your money, but I am here to remind you that small shifts, smart decisions, and protecting yourself first, those things lead to massive change over time. Don't wait for the perfect moment. Start where you are, learn what you don't know, and never, ever bet more than you can afford to lose. Because when the storm comes, and it always does, you want to be the one still standing. Stay smart out there.